It's time for Tycoons of Small Biz, spotlighting the true backbone of the American economy, the true tycoons of business in America, the owners, founders, and CEOs of small businesses. The show's hosts, Austin Peterson and Landon Mance, are registered representatives of Lincoln Financial Advisors Corporation, a broker-dealer member SIPC, and registered investment advisor. The views expressed by your hosts, Austin and Landon, are not necessarily the views of Lincoln Financial Advisors. Let's lean in as Austin and Landon connect with this week's Tycoons.
Good afternoon, Tycoons, and welcome to today's episode of Tycoons of Small Biz. I'm Austin Peterson. I'm joined by my co-host, as always, Landon Mance from Las Vegas. And if this is the first time you're tuning into our show, we'll just describe real quick what we do here at Tycoons of Small Biz. Our show is literally about propping up small businesses throughout the country who we know and believe are the true backbone of the American economy. Landon and I are also small business owners, and we both have parents that were small business owners. And we feel it's crucial that 99% of the businesses in our country get highlighted in some way, shape, or form. And we're trying to do our part through Tycoons of Small Biz. So with that said, we are excited to have on the program today, today's guest, Iliya Zogovich, founder and CEO of DBD Partners, LLC, coming to us live from Park City, Utah. Iliya, thank you.
Hi, how are you guys? Thank you for having me.
Yeah, we're excited to have you here. And we had our pre-show or our pre-call, I guess, where we discussed a little bit about your background and you being in Park City. And I told you that Landon and I both have ties to Utah itself. I grew up in Utah. I'm a snowboarder. I know you're a skier, and we'll get into that in a little bit. And, we've already started butting heads about the mountains in Utah compared to other places. So we'll see how this goes. I'll tell you what, we are excited to hear your story. So let's start there. Actually, tell us about Iliya, the person. How did you grow up? Where did you grow up? How did you get to where you are today? Family, kids, any of that kind of stuff that we'd love to hear.
Absolutely, yeah. Thanks for that. So I was born in Mexico City from a Yugoslavian dad and a Mexican-Italian mother. And when I was around 8 months old, we moved to Serbia. Well, Yugoslavia back then, this was before the separation. I lived there the first few years of my life. And then as things started to get shady and so forth, we moved back to Mexico. And, I think when I was like 5 years old, we moved back to Mexico City. And that's where I grew up. I grew up in Mexico City, went to school there, high school through college, started my working career there, etc. And eventually, when I was 32, I moved to New York City and been in the U.S. ever since, and recently relocated to Park City.
Yeah, that's great. So I have to ask, do you speak 3 different languages or maybe even more?
I do. I speak Spanish, of course. The first language I learned to speak is Serbian, which I still speak a little bit of it. I honestly don't practice it that much. I only speak with my sister and my mother sometimes when we don't want other people to know what we're saying. Yeah, and then I speak English. That's it. Other people, like my mother speaks 5 languages. My grandmother used to speak 7 languages. My sister, I think, speaks 4. So I'm lagging behind. I need to learn another one.
I tell you, it's kind of a lost art, or at least the understanding of the importance of something like that in our country here in the U.S. It's rare to meet people who speak more than one language, right? If you didn't grow up speaking the other language. Now, I lived in Europe for 2 years, and so I learned and speak French, and actually went on to get a bachelor's degree in French. And so I've done a pretty good job of keeping it up. And same thing, my wife and I, so my wife speaks French as well. My wife and I, when the kids were younger, we would speak French to each other when we didn't want the kids to know what we were talking about.
Nice. Did they learn any French, the kids?
So when my son was born, my son's now 21. When he was born, I spoke nothing but French to him for the first year and a half of his life. And then my wife's parents moved to Stockholm for a year and a half, and they asked us to come and house sit for them and live in their house. And we were still pretty young newlyweds. I was finishing up college. And so not having to pay rent was obviously an enticement. We finished a rental contract about a month and a half before they left. And so we moved into their house for a month and a half, and it just got to be too confusing with them and me speaking another language to our son. And so I stopped, and I wish I hadn't, because that would have been beneficial for my son. But he did actually go. So he started taking French in high school and dropped it because it was too difficult, and started taking Spanish because, as you know, the grammar is a little bit easier in Spanish than it is in French.
Yeah.
And then he actually just spent 2 years doing the same thing that I did when I was his age. Just got back in December from Denmark. So now he speaks fluent Danish.
Gotcha. No, I was asking that because I've read somewhere that if you speak to a child that's, in the first few years, in the forming years, anywhere between 1 to 5 years, and you speak in another language that their native tongue, it just activates something in their brain that will give them an easiness to learn languages further down the road. Mostly linguistically, maybe not that much the grammar and the writing and stuff like that, but they'll be able to pick up new languages. I don't know. I don't have kids, so.
No, I've seen those same studies, and I would say that it's definitely true. And it doesn't even have to be that it's that language, right? It's just the fact that, Spanish rolls out of the mouth differently than French does, than English does, than Italian does, and Danish is way different. So you get used to using your mouth a little bit differently than just speaking English the way that you always do.
Yeah. And I think it also, it makes some different brain connections. I was just speaking with my team the other day about like languages and stuff. And one of them asked me like in what language do you dream? And if I'm in the US and I'm dreaming about something going on in the US, I dream in English. But if I dream of my family, I dream in Spanish. If I'm doing business, I'm always thinking in English. If I'm doing math for a business, like while we're in a call or something like that, I'll do the math in English. But if I'm probably in my house just counting stuff by myself, I'll do it in Spanish. And I think that's when you're really bilingual or multilingual, when you start thinking in that language, not translating from another language to it.
No doubt about it. That's when I knew that I was truly fluent in French, is when I started dreaming in French when I lived in Belgium and France.
Yeah, for sure.
Well, Iliya, let me jump in real quick. Don't sell yourself short, my friend, because you are an investment banker and you speak M&A, which is a very foreign language to 99.9% of the population. So you got to get yourself that.
True. Okay, so I speak 4. I'll take that.
Right.
M&A or like New York City bullshitting, as I like to call it. We just make it sound way more complicated than it is.
That's right. Well, speaking of M&A, so DBD Partners, that M&A is part of what you guys do. But let's just start at the beginning. Tell us what DBD Partners is. You're a co-founder. So how did you get started, and what is it that you guys do day to day?
For sure. So I started working in investment banking. In my career, I started, back when I was in college in Mexico, I started working for a marketing company. Eventually, I did a management buyout of that business. I didn't know that was what I was doing, but I found a way of buying out the current or the previous owners, bought them out, did a roll-up of a bunch of companies, eventually exited that business. And I found it really, really interesting to do all of those transactions and how you can finance it and how you can integrate businesses and you can actually grow into different geographies, et cetera, without having to greenfield or the thing starting from scratch. You can just go and acquire and there's financial efficiencies and all of that. So that's how I started my career. I started mechanical engineering, nothing to do with finance or anything like that. But, you get a job and you start working and you figure out what you like. Eventually, when I moved to the US, I was working in the finance business back in Mexico, but most of the funding came from the US. We were doing direct lending to consumer and small businesses in Mexico and Latin America. And I really enjoy finance. I really enjoy, makes sense to me. There's artists that know how to paint and they see a canvas and they can just draw something, etc. For me, business and finance just makes sense in my brain. And in 2015, I was in between different projects and like exiting. We had exited the marketing business, where we're exiting the finance business, the lending business. And I met the chairman and CEO of One to One, which is one of the largest lower middle market investment banks in Europe through YPO and HBS. And he offered me to come work for him and start the US division of one-to-one. They had no footprint in the United States. And at first I said no, to be honest. I thought investment bankers were a bunch of assholes. That was and I still think we are. that was my insight. But he was pretty persistent and eventually invited me to spend 2 weeks in Madrid. And I was like, why not? Like, let's go there. And I really liked what they were doing and how they were doing it. So in 2015, I joined the firm to start the US division. We launched in January 2016 and quickly grew to be the most profitable division for them. But we also quickly grew to have differences of opinion on how the business should be run, but most importantly, the business model that they were running, or that they are running and very successfully running. It's a volume model. They need a lot of people, a lot of managing directors, partners as they call them, and a lot of deals, and they'll close like a third of the deals. That's their model, and they've been very successful at it. But quality, and it's more quantity over quality for them. And I couldn't wrap my head around that. So eventually in 2018, we decided to part ways. And me and part of the team in the United States decided to start DVD Partners, servicing what we figure out what is a underserved side of the market for M&A transactions, and corporate finance, because we don't do only M&A, we do all of different corporate finance. And yeah, in 2018, we spun off pretty much the entire team that I had in one-to-one. They decided to shut down the US operation. They didn't want to invest in growing the team here, et cetera, which was kind of the main breaking point. I wanted to build an infrastructure here to have US standards and US quality of service. And they wanted to keep on doing all of the back office in Spain and just, producing here, or giving the results here, but it wasn't going to be there. So that's how we decided to start DVD Partners. And, we've been doing that for the last 4 years.
Awesome. So talk to us more about your specific business model that's different from one-to-one, right? You talk about them doing volume, quantity over quality. So, what does a typical deal flow look like for you guys, for example?
Yeah. So what we did is we focus more on quality of deals. And my managing partner comes from UBS. He had the classic investment banking training and career, and then went to private equity, and then started a VC firm himself. But we brought the same process that big banks, UBS, and some of our other managing directors come from CD and some other big banks. We brought that process to the lower middle market. So the books that we create, the SIMs, which are the books that we use to go to market, if you see it, you won't see the difference between one created by one of the big banks in New York City and the ones that we create. Our financial modeling and all of that is up to par. And that honestly drives the value of the businesses up, but also opens doors with other potential buyers that would not look at what a business broker or your usual run of the mill market investment banker does, which is more of a chop shop, just very quick turnaround stuff. And that's not what we do. We focus on quality. We focus on perfection and going out to market with really, really great projects. So we don't take every deal that comes to us. We take a lot of time figuring out which deals we actually can bank and are going to be successful when we go to market. And that gives us a very high closing rate, but also lower numbers on the volume side. That's kind of our business model: quality over quantity.
Go ahead, Landon. I can see it.
That's great. And tell us, help us understand kind of you said that you're a little bit more focused on quality over quantity, and that you're pretty not exclusive, but you're really diligent in the deals that you take on to make sure that it's a right fit. And that's very similar to Austin and I's business model as well. But I'm curious, you say that you guys kind of focus in the lower middle market space. So I think most people probably don't know exactly what that means. So can you talk to us a little bit about the size of the businesses that you represent and kind of what the transactions kind of look and feel like?
Sure, absolutely. So what we define as the lower middle market are companies that are going to have an enterprise value of $250 million and below. We think once you get above 250, you're in the pure middle market. And if you're closer to $1 billion, you're in the higher middle market, and then everything above $1 billion is your run or the main street market. But anything 250 and below, we consider the lower middle market. Most of our clients are anywhere between $20 to $150 million in enterprise value, which, if you want to break it down for another easier metric to wrap your head around, their EBITDA is going to be anywhere between $1 to $10 million. And depending on the industry, et cetera, it's going to put you into that $20 to $150 million enterprise value.
Got it. Okay. Yeah, that makes sense. So is there a specific industry that you guys kind of focus on or really, gravitate towards, or are you really just looking at the company and determining if the company, is somebody that you guys feel is a good fit to bring to market?
It's the latter. We're pretty industry agnostic. There's some stuff we don't do. We don't do real estate, for example. We don't do retail. We don't do oil and gas, especially oil and gas on the exploration and infrastructure side of things. It's just, and we wouldn't do anything life sciences. If we need a PhD to understand what our client does, we're probably not going to be the best ones representing them. So that gravitates us naturally to more traditional businesses. So we do a lot in manufacturing. We do a lot in distribution, all sorts of business services, all sorts of technology consulting, software as a service, healthcare, especially on the healthcare services, healthcare technologies, healthcare consultants, stuff like that. Food and beverage. My managing partner in UBS worked at the food and beverage practice, so he did multi-billion-dollar deals with Nabisco and companies like those. I have a lot of experience with business services on the marketing side of things, which was a business I ran in Mexico, financial services, insurance. Once of our executive directors comes from a big insurance company in New York and ran their M&A, semiconductors, technology, and stuff like that. Sandy, our managing directors. So we're pretty industry agnostic. We have a lot of experience in different industries. But yeah, we focus more on having the right company and the right management team to run that business.
Yeah. Okay. So what I thought would be kind of hopefully beneficial, kind of helpful for our listeners and our people that are following along, is to kind of just set the stage from the get-go so that we can kind of understand the process that you walk one of your clients through. So hypothetically, Austin and I introduce you to, Bob Smith, and he started a manufacturing company, 30 years ago, and they've got they're making a couple $1 million a year in profit. And Bob is thinking, I think I might want to, get out of the business, and might make sense to sell to, one of his competitors, or a private equity firm or whoever, and they get introduced to you. So I'm sure we could spend hours talking about your guys' process, but just at a high level, just kind of help us understand, when someone gets introduced to you, kind of what would they expect to kind of get, and what would it feel and look like to work with you guys?
Absolutely. No, thanks. And yeah, we could talk about this for weeks probably. But I'll break down the process in some very easy steps. The first stage, that it's what we call the documentation stage, and it's when we document the deal, and that starts with us diving into the business. We like to get 3 to 5 years of historic financial numbers so we can see the insights of the business. At the end, a business is as good as the money it produces and how it produces that money. So our team will dive into the numbers and start rebuilding the whole thing. A lot of companies have really good CFOs that want us to use their projections and have this amazing 10 or 5 year story. We really appreciate them sharing it with us, but we're going to go back to the stats and do it ourselves, because that's the way we actually understand the business. And it's not because I want to do more work. It's like I need to understand the business from the inside, and the numbers talk to us. So that's part of what we do. And then we're also going to be getting a lot of information from the company. We want all of their sales documents, all of their product catalogs, main distribution area. Like, we want to understand the commercial side, the technical side of the business, etc. We gather all of that information, and with that we start writing the book, right? We also have a very important part of it, which is when we get our analyst team that's going to be writing that with the owner on the phone, for that person to tell us the story of the business. Because at the end, that's the best person to tell you how this business was started, and you can feel the passion when they're talking. You see where their faces lit up. You see where their tone changes when they're talking about certain times and certain things they do. So we do that, and with all of that, we document the deal. That means we build the book. Usually it's a 100-page document that tells the story of the business, paints the current state of the business, explains the market they play, the market playing field, and also tells the story of the future, both financially and with words. Like, this is where this business can go to. We try to do it very broad with clear triggers for different kinds of buyers, but you don't want to focus on one specific buyer or one specific asset class, because this is going to be read by a lot of people. The importance of the quality of this is not because I'm obsessive compulsive and I like things that are high quality. This is going to be read by a lot of people, and you need to make sure that the private equity analyst sitting in New York City will have a great understanding of it, as much as the German strategic buyer and maybe a family office based out of LA. And that document is actually how you're telling that story, and it gives a lot of context. So that's why we're so focused on the quality of that. We'll rebuild the entire model that goes into the sim, and finally, the last document we create is what we call a teaser, which is basically a blind executive summary of the business that tells you what the opportunity is, gives you an idea of the industry and the space, but never tells you can't retro-engineer to figure out which company we're selling. And we have certain trade secrets to make sure that can't happen. And that's the documentation stage. Then if there's any questions or anything, just stop me. I'm happy to dive deeper. At the same time, another set of our team is doing what we call the mapping. And basically what we're doing is we're seeing out in the entire universe of buyers who are potential buyers for this. And a lot of clients say, hey, my direct competitor is the best buyer. Yes, we're going to have all of your competitors, but we also don't want to forget family offices. We don't want to forget private equities. We don't want to forget maybe some of your suppliers or some of your clients that might be wanting to vertically integrate upstream or downstream. And for them, it's much more valuable than any of the other asset classes. So we'll map out the entire ecosystem. Usually this comes up with thousands of potential buyers, which we not only have the name, but we also, during that mapping process, have the contact information of the key person that's got the decision maker that we need to contact. A lot of them will already have connections. We've been doing this collectively for over 100 years. We have a bunch of databases and we buy more and more databases, etc. So we get all of that information and we go over it with our client. Sometimes they say, there's no way I'm going to sell to that distributor because he screwed me over 5 years ago, and take him out of the list. Okay, fair enough. and then we go to market. And when we say we go to market, the first stage is we go with the teaser, the blind executive summary. We reach out to the companies. We say, hey, we have an opportunity. we send it, we explain to them over the phone or over an email. We already have these conversations with them ongoing, so it's easy for us to get in touch. We share with them the teaser, and if they're interested in learning more about the opportunity, we'll get an NDA in place. Then they'll get on the phone with whoever is running the deal. So it might be me, our managing partner, one of our managing directors, whoever's running the deal. We'll get on the phone, usually a 30-minute introductory call, where we still don't disclose the name of our client, but we explain a little bit more about the business. We have an NDA, we give a little bit more of details, we narrow down the industry, et cetera, et cetera. If after that there's still interest, we give them access to the data room where they have the SIM, the book that we wrote. They'll have a copy of the financial model and some other information that we might consider important for them to have. This is a secure data room. They can't download information. They can only see it. Everything is watermarked. It's protected by the NDA, et cetera, et cetera. So we're very careful about our clients' private information. After that, we usually have a bunch of emails or conversations going back and forth, asking for more information, et cetera. And once they indicate interest and they explain, look, yeah, we are interested in buying this company, potentially buying this company. This is kind of the structure that we're thinking about. Then we get them on the phone with the client for what we call, an initial conversation. It's not a full management presentation, just an initial conversation. We want to make sure, this might sound weird, but that there's a chemistry between both parts, because at the end, even if it's a full buyout, there's going to be a 6 to 9 month period where you're working together. And if you just can't see each other face to face, it's just not going to work. And we rather save that time to us, to our client, and to the potential buyers. If there's that chemistry, we'll ask for a letter of intent from different buyers. We like running broad auctions, and basically a letter of intent. It's a term sheet that tells, this is what we see, this is how much we think it's worth, this is how we're financing it, these are the conditions to close, this is how we see the combined entity. There's a little bit of selling there of the buyer to the seller, and a lot of information there. We receive a bunch of them, we analyze them all, we present it to our client. Sometimes the company that's offering the most money, in our opinion, is not the best option because there's a lot of other things involved. And it all depends also what the client wants. Sometimes our clients are like, look, we're not focused that much on cash at close. We actually want to stay with a big chunk of the business for the second bite of the apple, or I'm more worried about my core management team to stay on board. I've already made my money, and yeah, it's nice to have another 20, 50 million bucks in my pocket, but I really want to make sure that my employees and my legacy stays for the long run. So we focus on all of those things. We prepare an analysis of all of the LOIs, and once our client, with our help and the help of family and attorneys, etc., decides, okay, we want to go with option A, then we sign that LOI, which usually has an exclusivity period of 60 to 90 days. 90 is the usual. And then you go into a due diligence. And that's, that's the hardest part of the process for everybody involved in it. You're going to have a bunch of auditors, quality of earnings, tax, legal, etc., just poking around your business, asking a lot of questions, and asking for a lot of information that sometimes you don't have, sometimes you have, but you don't really like to look at it. And you need thick skin to run through the whole process. Usually the buyer has a quality of earnings firm that's doing the quality of earnings. And a quality of earnings is just basically an analysis of all of your earnings to see, how they survive in the future and what's the quality of them. Can we actually count on all of this earnings moving forward? Is it going to be part of the business, or is it just a one-off, etc.? So we want to make sure that the earnings are what we're saying that they are, and not some financial engineering that we did to make it look prettier. There's also, tax. They want to make sure there's no taxes, no other liabilities, legal, audits, etc. So everybody's poking around the business for a good 90 days. And after that, if everything works correctly, 30 days into the diligence, the attorneys start writing the SPA and the purchase agreement, the stock purchase agreement, or an asset purchase agreement, depending what kind of transaction you're doing. But they start writing the purchase agreement, and we start negotiating terms and start negotiating business terms, and eventually end up with a workable document for both sides. And that document has a lot of information, everything from how the deal is closed, what happens after closing, if there's an earnout, if there's a seller's note, everything is contained there. But also there's this really obscure part of the purchase agreement called reps and guarantees, where you're representing and guaranteeing that everything you said and showed during the sales process is true and accurate. And there's clauses that say what happens if it's not. And if you break one of those reps and guarantees, there's liabilities and so forth. So that's a process. It's like a very long process in a very short, condensed manner. And it's pretty similar to when we're doing sell side, or when we're doing restructuring, or when we're doing capital raising, or when we're working on the buy side. So the process is pretty similar. Sometimes the emphasis is more in, like, if you're doing a full sale, that's a process. If you're just doing a recap, you don't have to tell the whole story of the business and et cetera, because you're more focused on the quality of the financials and how are you going to be able to service the debt. But it's pretty much the same stages, just different focuses.
I got to tell you, so I've been doing this for 20 years. Landon's been doing it for about 12, I think, if I have that number right. We've worked with M&A firms in the past. We've been involved in transactions. We know about a whole lot more transactions because of other colleagues that we have. And I've never, in that 20 years, had somebody that clearly, now you unpacked a lot, but that clearly explained the whole process and the way that it goes from start to finish. And so, a couple of things that I gleaned from that is, one, to go back to your comment about investment bankers, to use your words, being assholes. I think if we all had $1 for every investment banker that we met from Harvard that was an asshole, we'd all be rich, right? Because every one of them thinks they're the smartest guy in every room, right? But so I did have to get that out there. But what I see from you is, even though you guys are working in the lower middle market, the experience that you have with your team and the approach that you guys take, it's no wonder that you find such success in that market. You've chosen that market, but you do it with every bit of professionalism as the upper market works in.
Absolutely. Yeah. And thanks for saying that. But yeah, that's our objective. And I guess Landon was right. I speak M&A, so that's my forte.
Yeah. Well, I tell you, so there's one thing that I think may surprise our listeners. And, with M&A, I mean, this as well as anybody, it's cyclical, right? Yep. There's lots of deals, then there's few deals, and, the market's good, the market's bad. It's just like any other kind of market that you can think of. But I think that it may surprise our listeners to know what the market's like right now and what it's been like over the last 12 to 15 months. So talk to us a little bit about what you've seen over the last 12 to 15 months and what you're seeing now and into the next 12 to 18 months.
It's scary because it's been a bull market for the last 8 years. And it doesn't seem to be slowing down at all. And, I'm not going to get into economics and try to understand what's going on with the Fed and the Treasury and all of those things. But, I mean, if the interest rates stay low and investors are not getting returns in more secure assets elsewhere, I think M&A is going to continue to be one of the biggest growth strategies that private equities have. And of course, now you have SPACs and all. And I'm not an expert in SPACs, and I personally don't like the SPACs, so I'm not going to go in there. But I'm also not an expert, so I can't really critique them professionally. But you're seeing so much money going into the market. Like every single day, I see a new private equity that just raised another 200, 300 million. And that's a low end private equity. Like that's a first round. Usually their first fund is anywhere between 150 to 250 million, which means, if you consider they're going to put at least 2 turns on EBITDA of debt into anything they're buying. If they have $200 million of cash, dry powder, as we assholes like to call it, in the bank, means they're going to do almost $500 million worth of acquisitions, which it's an outstanding amount of money for one firm to be doing, especially if you're buying companies that are worth, anywhere between 20 to 100, and then you're putting some other stuff. So what I'm seeing, look, multiples keep on going up. 5 years ago, in the lower middle market, you were talking about anywhere between 6 to 8 times EBITDA. Now you're talking anywhere between 8 to 12. There's certain industries like healthcare, education, edtech, distribution that are 12 to 16. It's unbelievable. It's a great moment for business owners to be exiting, and not to get into politics or anything like that either. But there is, this looming tax reform coming that's going to make capital gains, etc., are going to be taxed at a higher rate. And we did an analysis, and if that whole plan comes into effect, you will have to get almost 3x, 3 higher multiple on your EBITDA just to get the same amount of money in your bank account if it comes into play, right? And I don't know if it's going to come into play, and I don't want to get into the politics of it. Also, not being a U.S. citizen, I don't really understand the politics, so but I understand the math behind it, and that's huge. I mean, it means growing at a 10% clip for 5 years to reach that level of liquidity. So we're seeing a lot of business owners saying, "Hey, how can I take advantage of this before the tax change?" And we're getting into that window because a correctly run process takes anywhere between 6 to 12 months. The average is around 9 months from start to close. So we're getting to that window where we're saying, if you wait a little bit more, because if the closest, and I'm not an attorney or an accountant, but what I understand is if you close in January or February of next year and the tax reform passes in March or April, odds are it's going to be retroactive to January 1st, 2022. And you guys understand this way better than I do. So yeah, there's a clock ticking, but that's what I'm seeing in the market. Huge multiples, an astounding amount of liquidity, and both buyers and sellers eager to get transactions done.
Yeah, no, I agree with you 100%. I think what's even more shocking is the fact that we've been in this bull market for 8 to 10 years, depending on how you look at it. And there's still all of this dry powder, as you say, on the sidelines. Like they're craving these deals, and you're thinking, where in the world do they have all of this liquidity still when we've done so many transactions over the last 8 to 10 years?
Yeah, I agree. It's just they keep on raising and raising and raising funds. It's mind-boggling.
I think Landon must keep putting the man's money to work, and that's what
I've heard that. I've heard that all the money comes from Landon.
It really does. Not all of it, but at least 25 to 50% is coming from my checkbook here. Iliya, one of the things that I love about having conversations with guys like you is that although Austin and I have a lot of great, really thoughtful, wonderful conversations with, business consultants and people that, advise on, exit planning and small business planning, et cetera. We have a lot of great conversations, but what I love about talking about with a guy like you is that you are you are in the trenches, and you are the one that is actually making these transactions happen. And so I want to take advantage of your experience so that we can pass along some good, nuggets to our listeners. So when you're dissecting an opportunity or a deal, maybe as you call it, what are maybe just, 1 or 2 or 3 things that you really look for in a company that says, okay, guys, like this is a legitimate business based on these one or two or three things. Like, we need to pursue this opportunity and dig deeper to it, because I think there's something here with this company.
Yeah, it's a really good question. If I had to dissect it down to three things,
or just maybe just a couple things that kind of pop
sure.
off top.
I mean, the first thing I like on a good opportunity, and let's say any business in any industry that like you can think of, if they had good information, for me, that's a win. Like if I'm on the first conversation and I can ask the business owner, what was your revenue last year? What's your EBITDA? What's your margin? What's your conversion rate? How much do you have in inventory? How much do you think your equipment is worth? And they have all of that information either on the top of their head, or they can quickly just dial their CFO and somebody just has the information. That for me, it's peace of mind, because that's the main thing. I want to know that the information, that we're not going to be pulling strings and herding cats to get that information. But also a business owner that has that kind of control over the information, it means that the business is running correctly. Then I want to see steady, cyclical, logical growth. Like I don't like to see spikes. And don't get me wrong, we can sell companies with spikes, either up and down, et cetera, et cetera. But those, you need to clean the noise of those and see what the actual business looks like in a 5-10 year period with clean growth. And I like to see that it makes sense. And I like it to be a little bit above the industry trend. Same thing, for example, with margins, right? Like if you're talking about a manufacturing business that has usually around 20, or the industry standard is around 20-ish margins, and they're in the high 20s, you like that business, or you're doing something right, and the buyers are gonna like that. So those are kind of like the things I like from the get-go. I like to see industries that are not highly consolidated, because that gives buyers an opportunity to consolidate that space. I also like the owner to tell me, well, if I had the money, I would go buy this guy down in Las Vegas, or I would go buy this guy down in North Carolina, because they're great at what they do. I actually don't like businesses or business owners that think that nobody does things better than they do and hate all of their competitors. For me, that's a red flag. Like you really don't know what's going on out there. Those are some of the things that I like dissecting. Now, you can have a business that it's a mess. They don't have data, or they have data, but it's not correctly organized, etc. But it's in a really, really, really hot industry. Then you can compensate for that. And I can be like, yes, we are going to take this business to market, just because there's such demand. And I know who the obvious buyers are, that even if I don't have the right information, I can build that information, but I know that it's going to be, it's going to be the pretty girl in the dance, and everybody's going to want to go out with it. So those are kind of the things that I look into: either a very solid business, correctly built, correctly analyzed with a lot of information, or a very, very hot industry that you pretty much can throw anything into the pot and they will buy it. Now, in my experience, the first, information, control, quality, will get you a higher multiple than a hot industry. Even if the hot industry is paying huge multiples, if you had a hot business correctly managed, then you would be the crown jewel.
So on the flip side of that, what is one or two things maybe that you look at and you're like, yeah, deal, it's a deal killer, or just too big of an obstacle to overcome?
One is delusional business owners. The business owners that think, oh, well, I read that the companies are trading at 20x, and unless you give me $100 million, for a business that's making $3 million in EBITDA, I'm not going to sell. That's not. I steer away from your classic startup VC deals where they're going to be the next Uber or the next Facebook, but they don't really have a clear path to get there. They just really like to have money. And that brings me, I think, when I sit across the table with somebody that just wants to sell the business because they want to be rich, that for me is a red flag, because there's no passion into the business. I like business owners that if it was up to them, if we can't sell the business, I'll keep on running it. It's a great business. I really like what we do. I didn't build it to be sold. Those are kind of the red flags.
Yeah. Well, maybe I'm not sure if you feel the same way that I do, but I tend to steer away from people who have full heads of hair too. You just can't trust a guy like that. Oh my. All right. So let's kind of round this out and say, okay, so you've gone through the whole process, right? You've got the letter of intent. You got several letters of intent. You decide on who you're going to go with. You're filling out the purchase agreement. Everything goes as planned. Financing's in place. What kind of conversations are you having at that point with the business owners, whether they're selling it all or they're holding back a portion for the second bite of the apple? What other people are you bringing into the room at that time to help have conversations with them? What's the approach at that point?
Yeah, that's actually a great point, and a lot of times we forget about it. Once the letter of intent is signed, you need to start bringing some of your executive team to the table, right? Like the people that are going to be driving the diligence. You need your operations officer, your president, your accounting team, some of your key personnel, your key salespeople. You need to make them buy what we call buy into the deal, buy into the transaction. Usually, before we even have the LOI, we start talking with our clients about setting some sort of incentive in place, maybe giving them some phantom stock or even some actual stock, but they need to stay with the business for 2 to 5 years after the transaction for them to vest that. So you need to create that buy-in from your management team. The conversations I have with business owners during that process, I mean, every other week they back away from the deal because it's a business they built for the last 30 years and they don't know if they're ready to sell it. It's like selling one of your kids. Like, this has been part of my family, and honestly at that point it's like, it's up to you. Like, do I want my success fee at the end of the day? Of course, that's where we make most of our money, but I don't want you to sell something if you're not 100% sure about it. How do I know these guys are going to do right for what they said they did? And that's why we have all of the conversations during the LOI selection. Like, do your diligence. We do a lot of diligence for them, whether it's a strategic or a financial buyer. These are previous transactions. We always recommend the seller, hey, get on the phone with somebody that has sold to this same firm before and see what they think. Get on the phone with some of their key personnel that's not part of the transaction. Somebody that works for another platform company or in another division, if it's a big multinational that's buying you. Get a feel for the culture. See if you feel comfortable with your company being part of that. So those are all of the different conversations. What if I leave it to my kids instead? Or how can I make sure that they don't fire my kid? He's not the brightest kid, but he's a really good kid, and I would love to see him have a future in the business. So we start working all around those things. What we start negotiating, if there's going to be a rollover equities when the seller takes part of the purchase price as equity in the new combined entity. Yeah. So if they're going to roll over some equity, especially if it's a substantial piece of the deal, well, what are going to be the checks and balances? Do they have a seat on the board? Is it just an observer seat? What kind of voting rights do they have? Are they going to get diluted down the road? Because, they can just be like, hey, we're going to do a capital increase and you need to come up with $20 million, or you're going to go down to 5% and now you don't have a vote. So we start talking about all of those things with everybody, with the seller, with the buyer, with our attorney, our client's attorneys, the buyer attorneys, just to make sure that everything is there. So those are the kinds of conversations that happen once the LOI is signed. We have all of the consultants and all of the advisors doing the diligence and running through documents, etc. But it's it's more managing the relationship. When the last day comes and the purchase agreement is signed, you want to know that everybody has all the cards on the table and they have all the knowledge they need to know, because that's just the start of the transaction. Now you have to integrate, you have to start working together, you have to be good on what the numbers said, etc. So yeah.
Yeah, I mean, those things that you mentioned are so important. You know, Landon and I get involved in a lot of that. Not all investment advisors do that, right? I mean, Landon and I are financial planners, not just investment advisors. I think we may even talk about this in our intro call with you, that, you know, investment advisors will come out of the woodwork when somebody's selling a business because they want to manage the proceeds, right? But Landon and I spend so much time doing the things that you just talked about, where we're getting them ready for that sale, you know, talking to them about the importance of having a good executive team, putting incentive plans in place so that they'll stick around after you've, you know, rode off into the sunset. Those things get missed so often by business owners, and they don't even realize that the value of their business goes up by them not being, you know, the business not being dependent on them. Right. And so one of the things that we do, and we'll offer this to you for any of your clients if you'd like, as a free service, that we have our clients go through 2 questionnaires, if you will. One is the owner dependency index, right? So how much the business is dependent on the owner. And then the second is the business exit readiness index. And that doesn't just measure the financial readiness to exit the business, but the emotional and mental readiness to exit the business, which may be more important, right? I mean, that's how we figure out if they're going to have some of the false starts that you talked about, where they're wanting to walk away from the closing table. Wait, I think I want to just hold on to this. This is my legacy. You know, it's making sure that they're really ready for that transaction, because it's the biggest transaction of their lives.
Absolutely. I totally agree. And I think we talked about this, you know, a couple of weeks ago when we had that intro call, but a part that it's not that I forgot of the process. It's just we don't do that part, but it's equally as important when you start thinking about a transaction. Sit down with a really good financial analyst, financial planner, and figure out how much money you really need and what are you going to do with that money. Because $50 million might sound like a lot of money, but if you have a bunch of debt in your company, plus, you know, you own your house and the vacation home, and you promised your wife that you were going to buy her another vacation home, and you want to put 4 kids through college and you know, full ride, etc. That $50 million after taxes starts to look smaller and smaller and smaller and smaller, and all of a sudden you're not left with that much if you don't manage it correctly. You need to know how to do that, which it's one thing we don't do that. And when clients ask me, I always refer to way more capable people like you guys. But it's so important, because at the end, you know, sometimes they're sitting there with their check and you see they're not really, really happy. Like, you just made $40 million. Like, well, after taxes and after paying the mortgage off and this and that, I'm really just left with 5-6 million, which sounds like a lot of money, but if you still have 40 years of active life ahead of you, it's not that much. So that's another really important part of the pie. And then what are you going to do after you sold your business? It's like, that's a huge other thing. That's an issue for a whole other conversation with somebody else, because I don't know, but you guys should definitely speak with like an executive coach or a person like that deals with post-closing depression.
No, it's definitely a real thing. I mean, Landon and I have mentioned this on the program before, and we mention it with clients all the time, that most business owners, regardless of how big or small their exit was, a year and a half later, they profoundly regret having sold their business. Yeah. And it has nothing to do with the finances. It has to do with the fact that what they just built is no longer there, and they didn't have something else that they were passionate about to replace it. So I'm going to let Landon have the final word, but I've appreciated the conversation.
Yeah, I had this grandiose plan. I was going to tie a bow on this conversation, but you guys literally just you stole my closing thoughts. So no, it's all good though. But no, this was a great conversation. And based on what you guys just talked about, that very last topic here, which is the business owner not really doing life after business planning, maybe a suggestion for, maybe one of your associates would be go back and call all of your old, all your clients that you've gone through a transaction with and say, hey, it's been a couple years since we talked to you, but how are you feeling about your life now that you don't own your business anymore? And it'll provide some really good insights to you and your team, because you can talk to a client all you want until you're red in the face about mentally preparing yourself for an exit, right? And Austin and I, literally, we've had this conversation probably a half a dozen times this year alone, where we're telling our clients, like, look, when you sell your business and you wake up that next day and your phone is not ringing and people are no longer depending on you, you're not the head honcho, you're not this decision maker, you don't have the corner office anymore, your suppliers aren't calling you to play golf anymore. Like, you can't prepare somebody for that with words, right? So I'd be really interested to see if let one of your associates go back and call your clients, and we'll have you back on the show in 6 or 12 months, and you can report back to us. But I would be curious, and this thought is just kind of coming to me. I heard this one guy, I think he was an exit planner or something, and he said that one of the exercises that he takes his clients through before they actually transition out of their business is he tells them, I want you to completely remove yourself from the business. No phone calls, no emails, no meetings. Like, basically, like, you are dead to the business for like 2 weeks. And then at the end of that period, we're going to sit back down and I want to know how you felt, what your thoughts were, what you liked, what you didn't like, what you do in that 2 weeks. And it's just that I thought it's a pretty cool exercise to try to take a client through before they actually sell their business.
I like it. And I'll for sure have one of my associates go back to all of our clients. I'll report back to you guys.
Yeah, that would be that'd be awesome. Well, Iliya, this was a really cool conversation, and I'll just make one last closing note that it's so cool how this conversation came about. One of your associates just reached out to me out of the blue, sent me an email, told me about who you were, and just said, would you be open to having a conversation with him? And I responded and said, yeah, absolutely, and had a great introductory call with you. We had no plan to invite you onto the show, but here we are and had a great conversation with you. So this is what we're all about here, which is just giving private business owners a platform to come on, tell their story, get some notoriety, get some publicity, whatever you want to call it, and hopefully this leads some opportunities for you. And that being said, somebody wanted to contact you guys. How do they track you guys down?
Yeah, our website, DVD Partners, like double-black-diamond-partners.com. The easiest way. Our emails is always our first name, so Iliya at dvdpartners.com. Yeah, that's the easiest way. LinkedIn and all of those platforms.
Fantastic. Well, Iliya, great conversation. Really appreciate all your thoughts and insights. And we're going to hold you to it, man. We're going to call you in 6 months so you can report back.
Absolutely, for sure.
All right. Thanks a lot.
Thank you.
You've been listening to Tycoons of Small Biz, proudly hosted by Austin Peterson and Landon Mance. Austin and Landon are comprehensive financial planning professionals specializing in financial, estate, and succession planning for small business owners. Austin and Landon have offices in Scottsdale, Arizona, and Las Vegas, Nevada, and represent clients in 14 states throughout the country. Join Austin, Landon, and the featured tycoons live every Tuesday at 1 p.m. right here on Business RadioX and your favorite